Good afternoon to everyone and welcome. I hope you have a pleasant day today. My name is Panagiotis Marinou. I'm the Programs and Business Development Manager here at the EIMF, and I will be moderating today's webinar under the title Transfer Pricing, Key Amendments to Article 33 of the Cyprus International Tax Law. We're very glad by the fact that the webinar received very much interest, and we have received around 300 registration, which seems to be a hot topic at present. At this point, it would be nice if we have foreigners to write in the chat box the country of your origin, so that to be aware where you are located. Regarding the questions, you can place your comments or questions in the Q&A box, chat box, during the presentation or at the end. Questions will be answered at the end of the webinar during the Q&A session. Participants will receive the PowerPoint slides after the end of the course, and as always, the webinar is recorded, also is live on our YouTube channel, and the recording you will be able to view it again at your own pace after the end of today's live presentation. Briefly to mention about European Institute of Management and Finance, EIMF, we're an accredited and licensed training provider offering learning and development opportunities, including numerous global qualifications, by partnering with international professional associations. With a presence in London, Brussels, Frankfurt, Belgrade, Copenhagen, Cyprus, and Tel Aviv, and over 5,000 students per year, EIMF is a leader in the field of vocational education in the wider region. So, as already mentioned, we're very excited to present today the topic transfer pricing, key amendment to Article 33 of the Cyprus International Tax Law, and even more excited to have with us our good EIMF associate trainer, Pantelis Karounias, to deliver today's webinar. Pantelis holds a BSc in accounting, and during his studies, he was awarded with many distinctions, including the first prize for the best academic performance. He is a fellow member of the Association of Chartered Certified Accountants, and he is a holder of the Advanced Diploma in International Taxation, which is awarded by the Chartered Institute of Taxation. Pantelis has over 20 years of experience in Cyprus taxation, international taxation, transfer pricing, and EU VAT, with a deep understanding of tax laws and regulations. He has worked with international clients from various industries, including shipping, manufacturing, retail, software, and financial services, helping them transform their tax and VAT strategies. He has presented various in-house and open seminars concerning taxation, with emphasis on international taxation, transfer pricing, tax planning, and VAT. The webinar will provide an overview of the key relevant law amendments to safeguard full compliance with the transfer pricing regulation and mitigate the transfer pricing risk exposure. Participants will have the opportunity to familiarize themselves with the new transfer pricing development in Cyprus and provide a practical environment in which these can be applied to hypothetical situations. So, Pantelis, we're ready to hear about your insights and your valuable information. So I'm handing over, and you can start your presentation.
Good afternoon to everyone. I'm Pantelis. Today I will present you the key transfer pricing amendments in the relevant Cyprus income tax law. But I will also explain the key concepts of transfer pricing and arm's length principle to ensure that the changes, the amendments, will be clear to everyone about the impact to their daily operations and especially for the ITRAN group transactions. As you can see from the slide, we have 4 major key amendments in our income tax law in Article 33 specifically. And based on those amendments, Cyprus actually safeguards the full compliance with the OECD TP guidelines. Okay, I will start with a brief introduction about what is transfer pricing and how transfer pricing is affected by the so-called arm's length principle. Both concepts are adopted by OECD, and this is what I will analyze in the first part of our presentation today. What is transfer pricing? Because we have a lot of discussions around this key topic, which is also affecting the tax liabilities, but it's not only about tax. Transfer pricing in general, it's about the policies, the procedures that an M&E group is using to price, to set up the prices when ITRAN group transactions are occurred between the group members. Those could be in the nature of transfers of physical goods, transfers of intangibles, or even the provision of services. And when we are referring to the transfer price, it's about the price used for pricing those ITRAN group transactions. Therefore, it's clear that transfer pricing is affecting both the financial and the commercial relations between the related parties, but also their tax obligations, as we'll see later on. To make it clear, I will start with when we don't have an issue of transfer pricing. Obviously, when we have a transaction between non-connected parties, unrelated parties, the so-called market forces are in place for the proper setting up of the selling price. The invisible hand, as Adam Smith wrote in his famous book. But what is the meaning of market forces in general? For me, it's very simple. The seller wants to get the maximum possible, and on the other hand, the buyer wants to pay the minimum possible. Those two forces, through negotiations, bargaining, are the key drivers about the setup of the selling price. The price that the seller will be willing to sell and the buyer will be willing to buy and pay. However, when we have a transaction between connected parties, the market forces that we saw and analyzed in the previous slide are not in place because the two parties are related. So the setting up of the price is subject to manipulations, is affected by other conditions like the management of objectives or the tax objectives of the group. So transfer pricing is generally subject to manipulations by the management of the groups. This is the common understanding, and sometimes that affects also the tax liabilities of the group, the overall tax liability of the group. Generally, about tax, we have the shifting of income in low tax regimes and the shifting of expenses in the high tax regimes. You have to remember, as we saw in the previous slide, that what is creating income for the one party, the seller, it will be an expense for the other party. Let's see an illustration to understand better how transfer pricing could be used for affecting the tax liabilities of a group. I'm using a very simple example. We have a Cyprus company which is producing pharmaceuticals and is selling to another member of the group, which is established in Greece, those goods. Then the Greek company is selling to third parties in Greece those products. I will use one transaction to explain how transfer pricing is affecting the tax liability. We have a sale of 100 units by the Cypriot company to the Greek company. The market value of those goods is 750 and the production cost is 350. In other words, the price that the Greek company will be using to charge the third parties will be 750. On the other hand, the cost of production is 350. Overall, obviously, the total profit of the group will be 4. This is the total profit about this transaction. The issue is how that profit will be allocated between the Cyprus company and the Greek company. Transfer pricing is the key driver about that allocation. In other words, the price that the Cyprus company will charge the Greek company, the transfer price, will affect this allocation of the total profit. The higher the price, the higher the profit will be for the Cyprus company. The lower the price, the higher the remaining profit for the Greek company. Let's say that the transfer price is 6 euros. Effectively, the sales, the total sales based on that transaction for the Cyprus company will be 600. At the same time, this 600 is the cost of sales of the Greek company. It's very important to understand this interaction, how the transfer price is affecting the profits of both related parties. The one party is having income, for the other party, the transfer price creates an expenditure. Based on a 6 euros transfer price, we have a taxable income for the Cyprus company of 200 and 140 for the Greek company. And the overall tax liability of the group based on that allocation of profits will be 58.60. What I want to highlight is the fact that the Greek tax is much higher than the Cyprus tax rate. Obviously, that means for tax purposes, it will be beneficial for the management of the group to transfer profits from Greece to Cyprus, because in that way they will reduce the total tax liability of the group, because they will reduce the taxable profits in Greece where the higher tax rate is. So instead of 6, if they decide to use 7 euros as the transfer price, effectively the revenue for the Cyprus company increases to 700, and in the same way, the cost of sales for the Greek company increases to 700. In other words, by this increase in the transfer price, we have a shift of profit of 100 from Greece to Cyprus. Consequently, the total group tax liability is reduced to 47 and 10. It's obvious that by using this transfer pricing policy, the group reduces the tax liability by 11.50, which is a big saving just by increasing by €1 the transfer price. So based on what we saw in the previous example, I think it's clear that transfer pricing is affecting the allocation of profits between the connected parties, between the group members. And that's why it's so important for the tax authorities, because they don't like this profit shifting and the base erosion, the shifting of income from the higher tax jurisdiction to the lower tax jurisdiction. One of the main tools that the authorities are using to eliminate the effects of transfer pricing techniques, tax planning through transfer pricing, is the so-called arm's length principle. Arm's length principle, it's an anti-avoidance rule. And allow me to highlight something here. What we call as tax planning for the authorities is tax avoidance. So arm's length is an anti-avoidance rule which is in place to eliminate the effects of transfer pricing, tax planning policies. And how it works, it's very simple. It's about adjustments of the profits that are understated in order to get back the tax revenue that was lost. Arm's length principle is fully adopted by the OECD, specifically in Article 9 of the OECD Model Tax Convention. This is the model used for the drafting on double tax treaties by various countries around the global. It's a very important model. And in Article 9, we have a provision about the transfer pricing, the arm's length principle. And basically, the idea behind that rule, it's very simple. As I said, it's about ensuring that the prices, the transfer prices used for intra-group transactions are the market prices. Of course, what is the meaning of market prices? It's about a very big debate, as we'll see in the following slides of our presentation. Here I have the extract of Article 9, Paragraph 1. This is from the Model Tax Convention. Allow me to explain what is the practical application of that. Paragraph 1 of Article 9 actually is giving the right to the country which is losing tax revenue to increase the taxable profits of the enterprise which is understated its profits through transfer pricing, basically. And in other words, what we have here, it's about an upward adjustment. It's about an increase of the taxable profits of the company with the understatement. And if we consider the example that we saw previously, it will be, in our case, an adjustment about the profits of the Greek company. They have the right to do so if they can argue through and assess actually the company through reasonable arguments that the transfer price was not an arm's length. In other words, it wasn't the market price. It was higher or lower. The Article 9 is just giving the right. We don't have any guidance in the OECD Model Tax Convention. The guidance is given in another work published by the OECD, the so-called OECD TP guidelines, which are recently amended. Actually, we have a huge amendment in those guidelines, which is effective from January 2022. The various amendments were based on the so-called BEPS actions, which is about the elimination of the base erosion through the profit shifting. What I want to highlight is that those guidelines are consisting soft law. In other words, they are not binding. It's just guidelines. It's not real legislation. However, they are highly influential. They are adopted by the OECD members and also by many non-OECD members. For instance, Cyprus fully adopted the OECD tipping guidelines through the recent amendments that we'll discuss later on. Those transfer pricing guidelines, it's about a very, very huge information. It's about almost 700 pages. And it needs a lot of effort to understand and apply those guidelines. It's about 10 chapters. The first 3 are the core chapters. It's about the arm's length principle, the transfer pricing methods that are preferable by OECD. Mainly, we have 5 methods, but the favorable one is the so-called comparable and controlled price. In chapter 3, we have the so-called comparability analysis, which is about guidance about how to gather comparables in order to arrive to what is the most suitable transfer price for an intra-group transaction. As you can see, we have also special chapters which are giving guidance for specific areas. For instance, chapter 6, it's about intangible properties, and it's about guidance how to deal with transfers, transactions involving intangible properties. We have chapter 7 for intra-group services. Chapter 8 is for the so-called cost contribution arrangements, which is another special area. A very important chapter, it's about business restructurings. And basically, it's about barriers and transfer pricing adjustments when we have restructurings involving the transfer of assets from one state to another. And finally, chapter 10, it's about guidance in relation to financial transactions. As I said, it's about almost 700 pages. And it's about detailed guidelines, providing guidance in regards with transfer pricing and how to calculate, estimate the best, more suitable transfer price for an intra-group transaction and safeguard that no adjustments or disputes will arise in the future. What are the problems with the arm's length principle? First of all, we have problems in regards with the information, either because there is no information, or we don't have comparable prices available, or the cost that we have to pay to gather that information sometimes. So we have problems in regards with the collection of data. Another big issue is the risk of an effective double taxation, because when we have an adjustment by the one state, as we saw, Article 9, paragraph 1, provides for an upwards adjustment, and that will be made obviously by the country that is losing tax revenue. There is no guarantee that we'll have another adjustment, a compensating adjustment by the other state, and that effectively will create double taxation. What are the solutions for that? We can use the so-called advanced pricing arrangements, and this is something that we'll cover also later on. It's adopted by Cyprus based on the recent amendments in Cyprus income tax law. And also we have the so-called alternatives to transfer pricing, the so-called unitary taxation, the formulary apportionment based on various factors. This is something that we have discussions and a big debate for many, many years now, but we don't have real concessions so far about that. I think you are aware about the so-called common tax rate or Pillar 2 now, or BEFIT. All of those are dealing with alternatives to the arm's length principle. Okay, I think it's time after this brief introduction to move on to the key subject for our webinar, the new transfer pricing legislation, the amendments actually in Article 3 of Cyprus income tax law. As I said, we have 4 major amendments: the introduction of a participation test, of a minimum participation test of 25%. We have the requirement for submission of a summary formation table. We have the requirements for detailed transfer pricing documentation, local file and master file. And finally, we have the right provided based on the law to taxpayers to apply for advanced pricing arrangements for tax ruling, actually, in regards with the transfer pricing policy of the company. The new amendments were voted into law on 30th of June 22. However, they are effective from 1st of January 22. And that means the first tax year that we have to use and apply the amended law is the tax year 2022. I have copies of the amended Article 33, actually Section 3, which is the participation test. So you can go through on those and see the wording as per the legislation. I will explain how that is applied. First of all, it's very important to highlight that this test, it's important to decide whether we have a connected parties transaction or not for the purposes of the detailed tipping documentation requirements. So it's a very important test. And based on that law, we have connected persons when the one person was directly or indirectly participating in the management, control, or capital of the other, or the same person or group of persons was directly or indirectly participating in the management, control, or capital of each of the affected persons. Let me show you some practical examples to ensure that this is clear to everyone. Company A is connected to Company B because Company A participates directly in the capital of Company B. We have, in this example, we have direct participation. On the other hand, Company A is connected to Company C indirectly through Company B. And again, we have the minimum threshold of 25% satisfied indirectly. The last example is when we have two companies being regarded as connected because the same person participates in the capital of both. As you can see, Company A participates in the capital of both Company B and Company C. And therefore, B and C, they are connected entities for the purposes of the transfer pricing. Summary formation table. That is another key amendment in our income tax law. Basically, all companies have to complete and submit this table on an annual basis. In this table, we'll have a summary of the related parties with which the company had ITRAN group transactions, and also information about the nature, the type of the transaction, in other words, and the value of the transactions. The summary formation table will be filed electronically, and the deadline is the same deadline with the deadline for the tax return submission. So for instance, for 22 tax year, what will be the deadline? Unless we have any extensions in the future given by the authorities. It will be 31st of March, 2024. So up to that date, the company, in addition to the tax return, will have to submit this summary formation table. Here I have an example about how this table will look. In the first part, we'll have information about the Cyprus company. And in the second part, we'll have information about the connected parties transactions that the Cyprus company had during the year. We'll have information about the related parties, their tax ID, their name, and also the country of residence. And then we'll have information about the nature and the values of the transactions. As you can see, we have four main possible types of transactions: goods, services, intangibles, and financial transactions. And we have a final column for anything else.
Pantelis, sorry for interrupting. Just a comment here. Is this table available in English as well?
This is an example. Actually, this table is not finalized and published by the authorities so far. So this is just an example, but of course I can write a translation on this to explain what is the meaning of each part. I can do that in order to submit this to the participants.
Clear. Thank you very much.
Okay. What I want to highlight before moving on, and it's very important to understand the effect of that, is that for each type of transactions, we have two columns, the outgoings and the incomings. And as you can see, we have to use the total, the combined total of both to decide, as we'll see, about whether the threshold of 750 for the local file is breached or not. But we'll come back to that when we'll go to the section of the local file. So about the summary formation table, it's compulsory to send it. And if a company fails to do so, we'll have 500 penalties. Another important amendment in our Cyprus income tax law in regards with transfer pricing is the requirement for detailed transfer pricing documentation to maintain the so-called local and master files based on some small size exemptions. For both, if the company is obliged to prepare them, it has to do it before the expiry of the deadline for the tax return submission. And upon request, the company should be able to submit that sorry for the interruption. Okay, about the maintenance of the TP documentation, as I said, for both the local file and the master file, they have to be able, upon request, to submit the local file and the master file within 60 days. Allow me to highlight also that based on the law, the local file must be reviewed by a person who holds a practicing certificate issued by the ICPAC. As I said, there is a small materiality threshold of 750, and if the total transaction for each category is above that threshold, the company has to prepare a local file for that company, for that type of transactions. The tool to decide whether the materiality threshold for each type of transactions is breached will be the summary formation table that we saw before. For instance, if for the goods we have 800 in total, 800,000, for the services we have 100, for the tangibles 50, and for the financing nothing, what we have to include in our local file, it's only information about the goods, because only for that type of transactions, the materiality threshold of 750 was breached. For the rest, nothing should be included in the local file. Okay, let's see two examples. The first one, it's about a company selling computer peripherals. So it's about goods. And during the year, it made a transaction of 1 million to a related party, another subsidiary of the group. Based on that, the company has to prepare a local file in regards with the goods transactions, because the threshold of 750 is breached. In example 2, we have the same company, but now we have 600,000 of sales and 300,000 of purchases. Again, we have a breach of the threshold. Why? Because the total 300 purchases and 600 sales is 900, which is above the 750 threshold. So again, we have an obligation to submit, to prepare and maintain a local file. And if the authorities request that file, the company will have 60 days to submit it. Let's see quickly the contents of the local file. We have to include in our local file group some information about the group, a general description of the activities of the group, the structure of the group, and also the residency of each entity which is part of the group. Also, we have to include some information about the local entity, the Cyprus entity, about its management structure, its business strategies, whether a major restructuring was occurred during the year, and also some information about the key competitors. Also, in the local file, the company has to include financial information. Financial information, it's about mainly the audited financial statements of the company, and also some schedules in regards with the calculation of the transfer pricing and how the results of the transfer pricing study have been applied for the calculation of the taxable income of the company. And finally, we'll have to include information about the control transactions, that is the so-called transfer pricing study. We'll have mainly to describe the related party transactions, state our functional analysis, that it's very important, is the essence about deciding which transfer pricing policy methods should be used, and also how to identify the best available comparables in order to reach a conclusion about the transfer pricing of the group transactions. Functional analysis mainly is the so-called FAR, as I used to summarize the meaning of functional analysis. It's about functions performed, the assets used to do those functions, and the risks assumed by the group entities in regards with the control transactions. As a first step, always you have to identify what is the asset used to make the control transaction, because based on that, it's easier to identify the functions performed and also the risks assumed. Finally, we have to include any tax rulings that we have obtained in regards with our transfer pricing policy. Okay, let's move to the master file. About the master file, to be honest, we will not have a lot of Cyprus companies to be obliged to prepare it because of the high materiality threshold. Only companies which are members of a group with consolidated income exceeding 750 millions, they will have to prepare a master file. So obviously, what is the more important practically is what we saw in our previous slides, the so-called local file. In the master file, for entities that they will be obliged to prepare it, we'll have some information about the group structure, information about the group business activities, the major activities of the group, the key value chains of the group. We'll have some information about the intangibles of the group and a list of the companies that are the owners of those intangibles, and also some information about the transfer pricing policies adopted in regards with intangibles. Also, we'll have to include some general information about the group financial activities. We will have to state the companies acting as the financing entities of the group, some information about the transfer pricing policies adopted in regards with the financial activities, etc. And finally, in the master file, we'll have to include some information about the financial and tax position of the group. We'll have to include the consolidated financial statements, any tax rulings obtained by the group members, the global, etc. Okay, let's recap. For both local and master file, as we saw, companies that are obliged to prepare them based on the materiality thresholds that we saw, they will have to prepare them before the expiry of the tax return deadline, and they have to be able to submit it to the authorities within 60 days upon request. If they fail to submit them, huge penalties will be imposed. It's very high.